and welcome to this episode of Mic'd Up. I'm Pete Seyler, a part of our business development team here at iCM, and I'm joined by Ryan Lehman, iCM's Director of Investments. Ryan, thanks for jumping in.
Hi, Pete. Always happy to be here.
All right, so let's kick it off. And after kind of an interesting start to the year, the S&P was marginally positive through the fourth week of June. And when we've seen strong leadership from non-U.S. equities, which seems to have surprised a number of investors. Can you take us across the performance landscape so far in 2025?
Yeah, absolutely. So it's been a bit of a wild ride for sure, with really the environment changing pretty much as quickly as the narratives changed. And if we think about where we were coming into the year, the hope was really for a business-friendly president that was going to keep taxes low, going to reduce regulations, and the expectation was that inflation and interest rates were going to both continue to decline. And what we saw as a result of that is both stocks and bonds advanced to start the year, with the peak for stocks occurring kind of right around the middle of February. Now, the narrative really shifted in the lead up to so-called Liberation Day, with markets now having to price in the impact that tariffs were going to have on those prior expectations. And the outcome that we saw was this steep sell-off in both stocks and bonds. So we had peak bond market returns occurring just after Liberation Day, as the market really needed to start accounting for the impact that tariffs were going to have on growth and inflation. And then at its peak decline, the S&P 500 actually approached near bear market territory with a loss of just about 19%. Now, at the same time, though, looking at non-U.S. markets, we saw pro-growth fiscal programs in Europe and lower interest rates. Combine that with a push from President Trump for increased NATO spending. And all this has driven international equities pretty significantly higher for the year thus far, with 20% gains for international value stocks. And if we look at EM value stocks, they're higher by over 10% so far this year. So I guess that said, since those lows, we've recovered most of the losses in U.S. markets, but international markets continue to lead the way by a pretty wide margin so far.
All right, can you talk a little bit about the overall fundamental landscape? How have we gotten here?
Yeah, quite a bit of stuff going on right now. So I mentioned a couple things already. So for us, I think it really comes down to the effect of tariffs on economic output, inflation, and then as a byproduct of that, earnings for both U.S. For U.S. companies, and then as well as our trading partners. And it really comes down to the contrast of these narratives that surprised just about anyone trying to really interpret the effects of what all this is going to have on the economy.
All right, so really, the general assumption has been that the U.S. growth would slow and inflation would kick up.
Yeah, it's exactly right. And then in addition, the general belief was that tariffs would be growth killers for our trading partners. And if we think about kind of how tariffs work, you can pay them in essentially three ways. So they can be paid by the consumer. So this is that inflation scenario that you mentioned, where consumer prices go up. Second, they can be absorbed by the importers, so a U.S. business, and their profits would essentially take a hit. And then finally, last option is they can be absorbed by the exporter. And all of these are going to have different impacts. And I don't think we've seen what that final version is going to be, unfortunately, until we get beyond the grace period that we're currently in and into a world where you have a trade deal or you don't. But at this point, we're really going to kind of have to wait to see to get a clearer picture of who's going to pay for all this. Now, at the moment, there have been a few firms passing through those costs, partially because they may still be working through inventory they purchased a couple months ago. And we also haven't seen a full earnings season with tariffs in place. So we don't really know what impact all this is going to have on profits or earnings or really consumer prices. And if we think about recent CPI and inflation readings, we haven't seen any meaningful uptick in CPI at all over the last couple of months.
All right. Now, Ryan, spending is kind of a bit of tale of contrasts. On one hand, you have the U.S. really cutting spending, seeming to implement somewhat of an austerity program, I guess you could call it. And you have Europe increasing spending. Can you talk about that a little bit?
Yep, absolutely. So if we just think about debt to GDP, so if we look at the U.S., our debt to GDP ratio currently stands at about 120%. If you look at the Eurozone's around 90%. And if we look at Germany, Germany's only at 60%. And thinking about what they just announced a $1 trillion domestic spending program. But the big difference between Germany and the US is they have some room to do it because their fiscal house is essentially in order. Now, if you switch over to the US, we're all watching this big debate that's going on around the so-called Big Beautiful Bill. And the general read that we're getting from bond markets is that bond investors don't seem to like the tax cuts that are baked in. They don't like the increase in assault deduction, the no taxes on tips, no taxes on Social Security, et cetera. And we kind of saw this in reality as that first round of the bill passed through the House, and you had Moody's cut the U.S. credit rating. So what we saw in the bond markets is you saw the 30-year yields bump up a little bit, even though they have come back down recently. So just thinking about it, at least at the moment, it seems like Europe will be likely able to boost growth by increasing spending, much like we did over the last 20 years or so. And then correspondingly, that rising tide should raise all boats. So European earnings should also get a bump as they get that fiscal stimulus. And then I guess one last thing to mention is there is still a war going on in Ukraine and unrest in the Middle East, despite what looks like at least a short-term resolution between Iran and Israel. But specifically, the conflict in Ukraine is not without impact on European equities. There is a bit of a, call it a war discount that's baked in or that's occurring, which accounts for any potential spillover that might exist and impact European economies or European stock markets.
So maybe we get a little PE boost in European stocks as this really draws to a close.
Yeah, I mean, absolutely. It's very possible. As you draw closer to a peace deal and that war discounts removed, European stock Ps should, at least in theory, start to expand a bit to remove the uncertainty that's currently discounted due to the war.
All right. Can you, moving on here, can you talk a little bit about the move in the dollar over the last few months and the impact that that's had?
Yeah, I think a lot of it's related to kind of what we've been discussing already. So everyone assumed the dollar would strengthen because of tariffs and higher rates. And this relationship is really driven by what's called interest rate parity. So interest rate parity basically says that the country with higher rates should theoretically draw in capital as investors could borrow money in their local currency at a lower rate and then invest that in the US, which has the higher rate. That hasn't happened. In fact, it's pretty much been the exact opposite. Now, we can't exactly say that we saw this coming because we didn't, but we did have the dollar as overvalued versus developed world currencies by as much as around 33% at the start of the year. So definitely a valuation mismatch there. And then if we look at what the dollar's done so far in 2025, it's actually weakened by about 8% just since its highs back in mid-January.
All right. So why did that occur?
Yeah, a bunch of possibilities, some of which are probably a little bit more realistic than others. So one is that foreign investors in U.S. Treasuries may be reducing their holdings. So think China or Japan simply selling Treasuries. This is one of the early narratives that we really didn't think was terribly likely. While I'm sure they don't mind hurting the U.S., especially after Liberation Day, realistically, if they sell treasuries and then they repatriate those dollars, all they're going to do is likely strengthen their own currency, not weaken it, which makes their goods more expensive on the world marketplace. Being export-oriented economies, this is something they wouldn't necessarily want. And then confidence, though, I think is kind of more likely the reason. And then also profit taking, maybe for those foreign investors holding U.S. stocks and bonds. The world's taking a good look at the fiscal stability and the fact that the U.S. can't really deficit spend their way to these high growth rates that we've seen over the last number of years. So I think the party's kind of over at this point, and dollar investors are starting to feel a little bit of that hangover.
All right, so let's take a step back to international equities if we can. Historically, they're not as represented in investors' portfolios. Have we seen this change, kind of given the impact of non-U.S. assets so far year to date?
So kind of, but not really. So the global cap weighted allocation, so if you were to invest in a truly passive portfolio, a global equity portfolio, it should include an allocation of about 36% to international stocks And of that 36%, basically 11 points of that would be allocated to emerging markets. If we look at reality, what investors are actually holding based on a number of different studies who have looked at this, it's right around 20%, which indicates that investors are pretty grossly underweight non-US equities. To look at it kind of a different way, though, if we were to look at ETF fund flows, so if we look at peak flows by dollars into US equity ETFs, going back to the end of the year, so December 2024, total was about $167 billion. In contrast to that, international flows were just a fraction, $30 billion into international equity ETFs. Now, the peak on a percentage basis, that was basically a month earlier, with the US taking in more than 90 cents on basically every dollar that was going into the ETFs. What we've seen recently is that this has changed right around kind of that March timeframe when international started outperforming. So there we saw US stocks taking in more than 50% of flows, or non-US stocks, I'm sorry, ETFs taking in just over 50% of flows on an average over the next 3 months. And then if we look at what's happened in June just far, it's been pretty one-sided, with international taking in just about 2/3 of all the flows in terms of net dollar flows into those ETFs. So I think investors might be coming around to the idea of more international, but we're a long way of seeing kind of this big wholesale change.
All right. So, I mean, with all of this information that you're giving, how, if at all, has the near-term outperformance that we've talked about changed our outlook going forward?
Yeah, not much at all, honestly. So international and emerging markets value stocks at their depths, they were trading at, say, a 70 and 85% discount respectively to US stocks. So these both represent just about 2 standard deviation events. Today, even with that outperformance that we've seen just in this kind of the short period of time, you're still at discounts of about 65 and 84%. So again, still right around those 2 standard deviation levels. So very, very wide compared to history. We still see double-digit gains over the next decade for international value stocks from these levels, gains of around 20% for EM value. And what we're kind of currently witnessing now is almost this perfect storm of historically cheap equity valuations as well as currency valuations. And then you combine that with some great potential to see cyclical low in earnings being replaced by a bit of a rebound due to all the stimulus that's occurring over there. So we still remain very, very optimistic on really both of these areas, international and emerging markets.
Great, Ryan. I want to thank you for joining me today, and thank you to our viewers for taking the time to watch this episode of Mic'd Up with ICM. If you have any questions or would like to suggest a future topic of Mic'd Up, please do reach out to us at 888-426-4689 or via email at info@icm-invest.com. Thanks for watching.